Okay, let's start our conversation this week on the Fed, which was the focus really for the economic calendar. And they were pretty predictable, which was they left rates the way that where they were, the federal funds rate where it was. And then Powell came in and talked very hawkish and said they were planning on raising uh, the Fed funds rate another quarter point before the year end, and that was pretty much the week. Because when he said that, the markets really went into a free fall. And so let's start with the markets here and the Dow Jones Industrial. These are weekly data, and you can see from these weekly data this week, that's an ugly candle too because you're there's a little wick down there at the bottom, but not much. So if you're a bear, things are looking good for you. That is one ugly candle. You go back in time here, you look at some of them more have been bigger, but uh, you know this doesn't bode well for reaching all-time highs. First order business would be getting back up here about 35 660 or so, and then looking to all-time highs from there at 36 958. But it's a falling knife kind of at this point. We definitely are in a strong downtrend here, and so we'll just have to see what transpires. We look at the S&P 500. It's kind of the same thing. Bottom kind of came out this week. And, even if you look at it daily, I mean, there's nothing good about the last really 5 days. Obviously, when Powell spoke, everything went to hell in a handbasket. So, that's, all the indices were that way. You look at the Qs, you kind of got the same thing. It's got a little maybe room down here to get to this uptrend. It started long ago. And you look at the Russell is it's back in a box that it's been in for like ever. Let's see, what date do we have here? That would be back in August of 22, maybe even down here, you know, going back to June of last year. So things look pretty bleak at the moment, to be honest with you, as far as bears or bulls go, and bears are partying on. You have uh, in the last 5 days. Look at the Russell is just, but it's in a box. It's been in a big box, and it doesn't seem to be going anywhere. We look at the 10-year yield, and it's been in an uptrend for a while, and it's uh, it's getting to levels that obviously ahead of this really high here back in October, and maybe the market should be much lower, and we should be grateful that it's not. But it gapped up. It's kind of working its way back down, but with the federal funds rate being another quarter of a point, it reacted to that in a very negative way. Um, the dollar continues to get stronger for the week. You know, several weeks in a row now, 3, 6, 7, 8, 9, 10 weeks in a row. The dollar's been in an uptrend, which is good for buying stuff overseas, but it's kind of a headwind for other things, the markets, commodities. But it's up here where it could run into some resistance. Where it is now, and then the next one maybe at 108, and then the next one at 114. So, for expectation is for it to roll over. It's not rolling over yet, anyway. The crude oil finally had a down week, barely, but we're still in this uptrend that we've been in since late June this year. And the VIX, it was down a lot at some point today, but it finished kind of back up, but down for the day, but for the week up. Above 16, where I saw some resistance potentially there. And then the percent of stocks over the 200-day dropped. So we're down, getting close to that 34%. Had worked its way back. I was hopeful up here around 63% would continue to broaden the number of stocks that were over the 200-day. But it was just, like I said, if you're a bull, it was a bad week. And let's see, the economic calendar starting this week on Monday. Not much on Monday. Tuesday, we had building permits that came in a little bit hotter. Housing starts a little lighter. And the mortgage rate kicked up to 7.31%. And I think after today, or after Wednesday, this number is going to be up 7.5% or so, just depending on what happens Monday and Tuesday next week before the next report. Thursday, Philadelphia Fed manufacturing was down again after it had been kind of looking like, oh, we got something, and then we have an anomaly, type of thing. And let's see, initial jobless claims were lower than expected. Existing home sales were down when the forecast was 1.5, but better than the previous month's report. And the PMI composite, meaning combination of manufacturing and service, 50.1, in line pretty much with what was expected. We're barely expanding. Anything above 50 is expanding. Anything below 50 is shrinking. Manufacturing still shrinking, though the number came in a little bit better than expected. Global services has finally started to make its way down a little bit. It stayed up here around 55-ish or so, starting to make its way down. But kind of waiting for service industry to be hit more by some of these rates. So that is pretty much it for this week. We look forward to next week, and we have Dallas manufacturing, which the numbers have been pretty ugly for a while. We got the consumer board, consumer confidence expected to go down, and new home sales at we're 4.4%. They're expecting it to go down 1.7%. And then we have the durable goods to be reported next week. We'll have the mortgage rate, which I'm anticipating will start getting closer to 7.5%, unless it backs off Monday and Tuesday. Thursday, we have GDP. Quarter over quarter, we have obviously initial jobless claims, and pending home sales will be reported during that time period. And then the big one really next week is going to be the core PCE. This thing is hopefully going to start moving down, although I don't see much hope of that when we look at our Truflation component here, where it stand at 2.66%, had been at 2.12. And, if you look at what my final comments were last week, it was that Peter Schiff was looking pretty good. Now after this week, he's looking even better as far as his forecast goes, because he thinks that oil and interest rates, all these things are going to continue to go up, and we're not seeing any real turnaround either in the markets or in crude oil, or um, you know, the federal, not the federal funds rate, but the 10-year yield. So we'll see what next week, what happens next week, and see if we can get this thing turned around. Or if you're a trader, then obviously, the tools of the trade, you can be using puts at this point, because it's looking like it can head down, uh, you know, going into next week. And so you maybe have to shift your mindset in order to accommodate this particular market. But things turn around quickly too. So we're in very strange times. The bars are getting bigger on the markets, and I said probably 3 or 4 weeks ago, this is going to be a roller coaster, and it has something to do with the end of this 40-year bull cycle. And I think this is going to continue, up or down. Nobody knows, but um, if you're nervous, you have to make your own call. But maybe cash is the best position. Anyway, that's what I wanted to cover this week. And remember, there's always a better way.